So today's the day. You made $1 million that needs investing. You walk into a bank and you got two advisors competing for your investment. The first one promises 18% a year. Then the second one comes in, but he confesses that he can only make you 5% a year. So, which is best? Which one are you going to give your hard-earned cash to? Quick. Well, if you still can answer without guessing, then this video is for you. So let me start with a wake-up call. A blanket statement to lay the basis of this course. One to hammer deep down your traders and investors' brains once and for all. Return is not performance. Never has, never will. Return alone only provides a very partial picture and actually does so from the worst possible angle, as I will show you in a minute. So much so that it is downright deceiving and meaningless in providing a reliable indication about the performance level of an investment or the ability of a trader to generate said performance. And whoever is telling you otherwise or portraying, say, 15% returns as exceptional performance is plain and simple, clueless, or lying to you. So before we go on, let's spell out what performance actually is. Performance is risk-adjusted returns. In layman's terms, how smoothly will an investment generate profits for you? Or how much will you have to sweat to make those profits? Performance is not a straight input like return is. Performance is an output. It needs reprocessing because it is a ratio. Let me explain. To assess and compare investments, you need a scale, and for that assessment or comparison to be fair, you need it to be normalized. Therefore, only a ratio can lead to an educated evaluation of an investment's worth. Likewise, only a ratio allows to proclaim who is the objective winner between two investments. Without that sound, normalized basis where apples are compared to apples, no sensible discussion about performance can take place. So how do we go about it? We normalize return for risk. In other words, we get to know how many units of return are generated for every unit of risk taken. So now, how is performance objectively quantified? Well, it is really not that hard. There are several ratios available out there, but in truth, all of these ratios are not created equal, and some are much more relevant than others. Right now, I will go over 4 of the most significant ratios: the Sharpe ratio, the SORTINO ratio, the gain to pain ratio, and the MAR ratio. Ready? So let's start with the Sharpe ratio. The Sharpe ratio is the most common of all trading performance measures, but it is crucial that you understand what it does because it embodies what performance assessment is all about. What this ratio does is that it seeks to identify how much excess return a money manager can extract over the risk-free rate per unit of risk taken. In simple terms, imagine that you deposit your money in the bank and you get a guaranteed deposit yield every year. Well, you don't need a money manager for that. No risk is taken, you get your interest at the end of the year, end of story. Now, if you want to make more, you have to take risks. That's when you must be able to quantify whether the risk taken by your advisor to make you more than that basic guaranteed deposit rate is worth it. And that is exactly what the Sharpe ratio tells you. CAGR stands for Compounded Annual Growth Rate. That's your annual return on investments. RF is the risk-free rate. That is usually the yield of US Treasury bills, which are, right or wrong, admitted to be totally risk-free. Now, at the denominator, you have sigma. Sigma is your risk, also called volatility, defined as the standard deviation. In the case of the Sharpe ratio, sigma is pretty simple to understand with the following illustration. Let's say that your investment grows from 0 to 10%. The dotted line is a risk-free investment to get you there. You get a steady straight growth to plus 10% with no surprises whatsoever. The red line, however, is a risky investment. How risky? Well, that's what sigma quantifies. Sigma is basically the average of the deviations of the red line, your investment's equity curve, above and below the dotted risk-free line. In other words, the greater the zigzag or volatility, the higher the risk, and vice versa. So let's go to our example here. Let's assume that your investment generates an annual rate of return of plus 8.10%. Your risk is 6% and the risk-free rate is 2.4%. Plugging these numbers in the above formula, your Sharpe ratio becomes 0.95. For reference, a good Sharpe ratio is considered to be of at least 1, and a very good Sharpe ratio is considered to be converging towards 2. Moving on to our next ratio, the SORTINO ratio is a variation of the Sharpe ratio. It is essentially the same except for one specific point. We now recognize that there is such a thing as good and bad volatility, and we no longer penalize performance for the former. In other words, our excess return is no longer normalized for the two-way deviation, but rather for our downside risk only. Taking back our earlier chart illustrating our sigma in the Sharpe ratio, we were interested in the zigzags of our equity curve, meaning both up and down. The greater the zigzags, the lower our performance. In the SORTINO ratio, we only focus on the negative deviations, the zags so to speak. And it makes quite a bit of sense. When you think about it, we actually want upside deviation, the zigs. We have nothing against big money-making days, right? So why let these specific days take away from our performance as is done with the Sharpe ratio? What we don't want, on the other hand, are big losing days. So these very downside deviations are isolated, as has been illustrated here. And that is what the SORTINO ratio will use as denominator. Simple. Next up is our gain to pain ratio. This one was popularized by Jack Schwager in his Market Wizards bestseller. It looks much harder to compute than it is. Basically, this ratio seeks to compare the sum of all monthly growth rates versus the absolute value of the sum of all monthly losses. Here, the risk-free rate is taken out of the equation. What we do is compare our ending net gain versus our total monthly losses. So in our example, assuming the following series of monthly returns, we get a total net sum of 7.5%. The sum of all negative monthly returns is minus 6.5%. So the absolute value is 6.5%, and it comes that our GPR ratio is 1.153. Just like for the Sharpe and SORTINO ratio, a GPR of 1 is good, 2 is excellent. Interestingly enough, you will find the GPR ratio is very close to the profit factor in its calculation. The profit factor is another very popular ratio, but instead of dividing the net total returns, essentially divides the total gains by the total losses. Lastly, here's my favorite ratio, the MAR ratio. The MAR ratio is the original basis for the Kalmar ratio that was derived from it and is only calculated over the past 3 years of track record. The MAR ratio takes the entire history of performance. It is interesting because it is both very unforgiving and pretty intuitive for the investor. Here's how it works. It compares the annual growth rate versus the peak risk of an investment, also called the maximum drawdown. Let's go back to our initial sigma chart. This is where it gets intuitive. Think of that peak risk as the maximum pain that the unluckiest investor would get if he decided to invest at some point during the life of the investment, but at the worst possible moment. Peak risk is therefore the worst peak to trough distance before the investment starts recovering again. And as such, maximum drawdown is extremely useful because it is a measure that is very real and immediately speaks to an investor. Take the Sharpe ratio for example. Would it be more significant for you to know that your investment's volatility is, say, 6% like in our previous example? Or would it make more sense to you to know that the maximum loss that you may incur before making money again is, say, 15% of whatever highest point that your investment has reached, right? Another big advantage of setting your maximum drawdown is position sizing, but I digress. This will be the topic of another course. So back to our MAR ratio. Let's assume that our investment has generated a return of 9.25% and a max drawdown of minus 8.5%. Then our MAR becomes 1.088. Here, a good MAR is considered to be between 0.75 and 1.25. An excellent MAR will converge towards 175. One last thing here to interpret the MAR ratio is that it can be read as a recovery ratio. In other words, how much time will it take your investment to recover from its worst run? A MAR greater than 1 typically indicates that less than a year is necessary to do so. That's important to keep in mind. Now, all of it is technical and sounds wonderful, but there must be shortcomings to these metrics, right? Absolutely. Let's look at the main ones. For starters, as we saw, the Sharpe ratio does not single out good from bad volatility. The consequence is a blurred out assessment of the actual risk taken by the trader. The SORTINO ratio does solve that issue, but just like the Sharp, it still assumes a normal distribution of trading outcomes, which has been proven not to be a good statistical depiction of reality. Why? Because just like price movements that they intend to act upon, trading outcomes tend to exhibit more frequent extreme movements than those modeled and assumed by the normal distribution. Next, the gain to pain ratio lumps all losing months and therefore does a poor job at reflecting downward spikes in the equity curve. For example, all the risk could be concentrated in a single month and the GPR would give you no warning about it. For the math-minded out there, think totally blurred out skewness and kurtosis. And lastly, the MAR does the opposite. It does give you a great sense of that peak risk, but provides little information about the average drawdown. That is how smoothly that equity curve is rising. In any case, as you can see, there is no perfect indicator of performance. However, nothing prevents you from blending two of them, like a SORTINO and a MAR for example. What's for sure though, is that these metrics are better than anything that is provided by the majority out there, which is just about nothing when it comes to objectively quantifying performance. I'll drop one last warning about the computations of these ratios. Be careful about the granularity over which these are calculated. Are the data points used for the computations registered on a daily, weekly, monthly basis, etc.? The rule of thumb here is, the tighter, the better. Let me explain. Here in red is an equity curve. Each point symbolizes an observation, in this case, monthly observations. Well, here's the problem. Because the frequency is too low, we only get a partial view of what has really been going on in this account. In our case, risk as represented by the maximum drawdown is largely underestimated if we go along with these monthly observations. Why? Because we lack the information of what happened in between each observation. The takeaway is that you should be very wary about performance statistics coming from low frequency records, as they may overlook a good portion of the true picture. Be sure to obtain as fine a frequency as possible, typically daily for a swing trading stock system, to minute by minute for say an intraday forex system. Anything more sparse than this has a high probability of being unreliable. So now you understand what performance truly consists in, that it is a proportion rather than a straight number, that it cannot be dissociated from risk, and that therefore it goes much further than returns alone. Knowing all this, would it surprise you to know that so-called professionals, and way too many of them in the asset management industry, consistently use the words performance and returns interchangeably? As absurd and unethical as it may sound, that is actually what the industry does all the time. Why? Because risk-adjusted returns do not sell. What sells is that glossy high rate of return. What sells is keeping prospective clients in the dark, playing on both their greed and financial illiteracy, and exploit the differential of knowledge to lead them on into purchasing a service that they would not have subscribed otherwise. So it can go both ways. Either the salesman in front of you is doing it complicitly, knowing full well that he is misrepresenting the value of the investment shown to you, in complete breach of his fiduciary duty, or it goes one notch higher in the pathetic. Many of these licensed, bank and government endorsed amateurs calling themselves professionals are so incompetent that more often than not, they're actually doing it in good faith, believe it or not, simply because they are too lazy, cowardly, and don't want to care enough. Yet all that both groups care about is to reach their sales target and get their paycheck. The financial outcome of your investment be damned. But tell you what performance actually is? Not for 1 second. As they say, there is no money in the truth. But I'll take it all a step further in showing you how returns that most tend to obsess over are being used at your expense. On top of being irrelevant to assess performance, returns can also be highly deceptive at many levels. First, as I just hinted, returns are most often used as an in-your-face marketing gimmick to blindside you to focus on getting rich quick and whitewash everything of importance when it comes to trading. Pushing crazy high returns to entice you is what scammers do and what people fall for, constantly. Likewise, and this is my second point, more often than not, a high rate of return is straight up a reflection of the exact opposite of performance. Why? Because it may betray many underlying issues with the trading agenda being pursued. In many cases, high returns are a dead giveaway of investment managers chasing performance fees. So the investment may look attractive for a while, until it turns south, that is, when true performance finally rears its ugly face. This is especially what is happening with the vast majority of hedge funds, which more often than not have just about nothing to do with hedging and reducing risk. And lastly, return is, up to a certain extent, nothing more than a choice, and everybody can get to generate whatever return they want for a while. Now I hear you over there. What is this guy on? You can't decide how much return you make in trading. It depends on your skills and results. Well, no, you're wrong. There are ways returns that can temporarily be inflated using leverage, even if you suck. All you need is short-term luck. Moving on to another very important nuance, logically, everything else being equal, increasing reward will necessarily lead to increasing risk proportionally. There is no magic about it. Performance is and will remain a fixed ratio until you change your algorithm. That's why it's reliable. You can, however, change and set the numerator or the denominator of that ratio as you wish. In that sense, return, which is the numerator here, is essentially a choice. How is it a choice? By scaling your positions. Simple as that. Let's use the following example. Assume a hedge fund that pulls a return of 15% per year with a maximum drawdown of minus 10% when fully invested. We're going to assume 3 cases here, and I will show you each time that returns are indeed a choice that can be changed while performance remains fixed and identical. Choice A, a very risk-averse client comes in and only wants to risk minus 5% instead of the standard minus 10%. What does the fund do? It only targets half the return by cutting positions in half and consequently does the same with risk. Your MAR ratio remains 1.5. Choice B. This is our base case. It is attained when the fund targets its base return and is fully invested. Your MAR ratio remains 1.5. Choice C. Assume that this same hedge fund goes all in to attract clients with a shiny rate of return. They leverage the heck out of their portfolio, say 2 times. By the way, if you think this is a lot, then you do not want to know how far some of these hedge funds are actually going with their unsuspecting clients' money. But I digress. Here your rate of return becomes a badass 30%, albeit with a not so good looking minus 20% drawdown. What does your MAR ratio do? Yep, stays the same, 1.5. So as you can see, return totally is a choice, with the only limit being how far leverage can get. It is sometimes dictated by risk aversion, but more often than not, led by business decisions that favor sales-driven marketing over being transparent about the actual value proposition. And speaking of value proposition, your new knowledge of investment performance should have you understand one crucial point by now. These fees that banking advisors, mutual funds, and hedge funds are so quick to charge you, right? These can only be justified by one thing and one thing only: outperformance. Outperformance commands fees, not how glossy the marketing brochure is, not how famous the investment manager, not how cozy that couch you were sitting on when you signed up was. It's all about risk-adjusted returns, and risk-adjusted returns only. This is also known as the alpha. That is just another fancy name to characterize abnormal returns or outperformance. So now you may wonder, well, outperformance, alright, but outperformance over what? Alpha means performance over the so-called market, represented by the closest index benchmark to your portfolio. In other words, it is the added performance over what you could have achieved yourself and do not need an investment manager for. That is the added performance over what a passive, buy and hold, zero risk management investment in this given market would generate. Why in the world would you pay fees to someone only for them to replicate something that you could readily obtain yourself? Makes no sense, right? So as a wrap up, we'll go over a case study using Portfolio Trader Pro as a real world example. We will look at the performance of the system and compare it to the market to check whether it actually adds value by creating that alpha. A more proper benchmark would be the MSCI World in this case, but for the sake of clarity, we will use the same index benchmark that was added by Collective 2, the S&P 500 index. So first things first, we need to check our statistical significance here. Well, what do we have? We have over 3 years of data. We have a net bullish environment that may play against the system since risk management was not crucially important, but we do have diverse bullish and bearish phases over 38 months, and we also have over 1,000 live trades. That's a pretty reliable sample. Now look at this chart. I guarantee you that a novice will take a look at it, see that the curve of the S&P 500 is above that of the trading system, and we'll right off the bat say that, therefore, the S&P 500 beats the trading system. That is the instinctive, ignorant way of looking at trading performance. That's what amateurs do, compare returns, and draw conclusions as to whom is lagging the other. But now you know better. Let's look at it with our ratios. And oh surprise, the objective picture now looks totally different once we adjust for risk. Every single one of our metrics prove the outperformance of Portfolio Trader Pro over the market. So indeed, once and for all, as you can see, it is entirely possible to produce less return and still outperform. Let me repeat this. It is entirely possible to produce less return and still be a better option. The only caveat being that you should be able to leverage your investment to adjust for return or risk as your risk aversion or risk appetite dictate. And to all the stubborn naysayers stuck in the return paradigm and whining that, oh, but the system still didn't generate as much as the market and money in your pocket is what matters at the end of the day. Well, let me go full circle on you and prove you how wrong you are. Remember when I said that the rate of return is ultimately a choice? So you want to focus on returns? Fair enough. Well, there you have it. Let's normalize for risk then, to match market risk so that we may compare apples to apples. Let's use the MAR ratio for a straightforward calculation. We realize that investing in the index is actually over 2 times more risky than our trading system. So what do? We adjust our account to margin and we leverage the system by up to 2.09 times. Typically, a broker will let you leverage an equity portfolio by up to 100%. So let's say we leverage exactly by that amount. We would still be a little bit below tail market risk, but whatever. In any case, for the same amount of risk taken, boom, here's your annual return. So what do you say? I say yes. I bet that straight passive investment in an S&P 500 ETF does not look all that good anymore, does it? So that will do it for this central topic. As usual, unlike other channels pushing fallacies on you guys, nothing in this course was told for you to accept blindly. All the math and proof of concept was provided to support the case. For the geeks out of you all, knowing how to calculate risk is really the cherry on the cake here. But for the others, at the very least, if these few minutes spent on this video did eventually get your mind to burn in the fact that trading returns mean jack without talking about risk, then you will come out a whole lot smarter trader for it. So if someone talks about return in front of you again, you ask them about their risk, systematically, flawlessly, 100% of the time. You cannot dissociate one from the other. This very notion makes part of the Hall of Fame of trading concepts that underpin the profitability of your trading systems and the efficiency of your money management. So that will do it for this course. If you have not already done so, I urge you to definitely do yourself a favor and watch from the start of the trading education series. Feel free to ask questions in the comment section, and for those of you who are allergic to math, rejoice. Our next classes will get more and more practical. It would not have been serious for me to get you started without the primary building blocks laid out in these first videos. These very concepts are precisely what other channels avoid in order to keep you from seeing through their crap. And as you know, that's not how we roll here. So stick around, definitely subscribe to this channel and share it with your buddies who, like you, are sick of listening to useless trading crap and want to become profitable traders. Until next time.